Welcome to the YouTube channel for On-Call Capital. I'm Bobby Jones, a retired nurse anesthetist and apartment investor. Today, I'd like to talk about something that comes up often in investor conversations, the subject of bonus depreciation. Now, I'm not a CPA or tax professional, so this is simply a broad overview that shouldn't be misconstrued as tax advice. Let's start off with the basics. What is depreciation? The answer is simply the decrease in value of a product over time due to wear, tear, and age. Think of buying a new car. Eventually, it is worth less and less over time as the mileage and wear and tear begin to build up. This is known as a depreciating asset. In accounting, when a business purchases equipment, they are able to spread out the cost of an asset over its useful life for tax deduction purposes instead of expensing it all in one year. This can be good for a company from a profit and loss standpoint. If a company makes a big purchase, it can negatively affect their overall earnings for that year. The preference is to spread out the cost over the useful life of an asset so that the company can benefit from the increased earnings of the purchased asset without a big earnings hit in year one. There are many different types of depreciation: straight line, declining balance, DDB, SYD, ACDC, STP, FOB. Wait, I think I'm just naming bands now. Let's just say I'm not looking to get into those weeds. The important thing to remember is that this is an accounting tactic that helps businesses report a loss in a certain fashion on paper. They still spent the money to make the purchase, regardless of how the accounting looks. Let's move into real estate now. On the other hand, bonus depreciation is a tax incentive that allows a business to immediately deduct a large percentage of the purchase price of an asset. In our case, apartment buildings. In the first year, they can do this rather than write it off over the useful life of an asset. The Tax Cuts and Jobs Act of 2017 made major changes to the rules of bonus depreciation. The biggest change was increasing the bonus depreciation deduction from 50% to 100% of a qualifying property. Well, what that means is that you can take 100% of that deduction in year one. Now, while this does phase out by 2027 in its current form, it's a powerful tool right now. Historically, residential real estate has been allowed to depreciate over a period of 27 and a half years. So a purchase of a $275,000 property, not including the land, would yield $10,000 in depreciation each year for the next 27 and a half years. That's a great benefit for sure, since real estate has actually been shown to be an appreciating asset. But what if you don't necessarily want to own the property for that long? That's where bonus depreciation comes in. It allows you to accelerate that depreciation into year one of owning a property. Combining that with a cost segregation analysis, which is a topic for another video, an investor can then take that depreciation and apply it to any passive income that you have, saving top earners tens of thousands of dollars. If you're a part owner in a group practice or you invest in businesses, it's possible that you receive K1 passive income that can be shielded by this depreciation deduction. This is where you can really add to your overall returns. But you don't have to be a big shot to benefit here. Another benefit is the ability to still spread out your bonus depreciation over the time that you own an asset. Let's say your K1 statement for an investment shows that you have $35,000 in depreciation deductions in 2020. If you're getting cash distributions of $5,000 per year, you wouldn't use all of that $35,000 in the first year. But you can march out that depreciation over the next 7 years to completely offset that income. Your window for using that bonus depreciation lasts as long as you own the asset, which is typically 5 to 7 years for an apartment investment. What this means is that you can essentially create tax-free or tax-minimized streams of income by investing in apartment syndications. Pretty cool stuff, eh? As with any investing, though, you should check with your tax professional to make sure that you are taking the right steps to keep as much of your own money as you can. With high earners, it's not necessarily about how much you make, but how much you actually get to keep. That's going to do it for this video. I hope you enjoyed learning more about bonus depreciation. If you found value today, I'd appreciate it if you hit subscribe and stuck around. I've got a lot more content planned for the months ahead. If you have questions or you want to reach out to me, please visit my website at www.oncallinvestments.com or email me at bobby@oncallinvestments.com. Thanks for watching.